Okay, welcome to today's session of Money and Capital Markets. So our focus for today is dwindling. So we're still looking at the capital budget and structure, we're looking at debt and equity, but we're leaning more towards equity and the valuation of it. So this session is actually two parts. This topic is in two parts. There's one part that deals strictly with stock valuation, then the other part deals with risk and return. Are we all ready to start? Okay, now a bit of a background on this session. In the previous sessions, I'm sure you discussed the types of financing that each firm requires, right? We have different types of financing, good equity financing and debt financing. Under debt financing, in the previous sessions, we looked at bond valuation and we discussed what bonds were. Now, our focus was this equity valuation, but then for you to understand what equity valuation is, we need to note down what equity itself is firstly. So what is equity? In our previous session, we discussed this. What is equity? How would you define equity in your own words? How would you define equity? Can anyone give it a try? What is equity by definition? Hello?
Okay, I can give it a try.
Yes, please go ahead.
Yes, so it could be defined as startup capital or finances that one needs to set up a business or to start up a business.
Yes, exactly that. That's what equity is. So, generally, it's what you use out of your own pocket, out of the owner's own pocket, that you're using to start up a business or to finance a business. Now, equity, unlike bonds, is broken down in two types. Equity, unlike bonds, is broken down in two types. You have what you would call your preference share and your common shares. So how would you differentiate the two, preference shares and common shares? How would you differentiate them? How would you differentiate between preference and common shares? Preference stock and common stock. How would you differentiate the two? Hello?
Oh, now that noise in the background.
Okay. How would you
Okay,
differentiate
I
them?
will try.
Yes, please go ahead.
Yes, so I hope I'll get it right. So preference shares is these are finances that are outsourced from other stakeholders.
Yes.
Then preference, then common shares. These are the finances that are put together by the owners of the business.
Yes.
Startup.
Yes, but some degree that is right, yes. So the major difference in these two is that your preference shares are types of shares that don't have an expiration date. They don't have maturity. So they're not timed by any maturity period. So for this, because they're not timed by maturity period, the rate of return is constant throughout. So you find maybe 12% of your investment, they are perpetual in nature. So you find there's no time factor attached to them. Just a moment. Yes, so they're not tied to a time factor. So for preference shares, you're just looking at it from based on perpetual kind of setup. So there's no time factor I'll get to them. So they're never in the infinite in nature. And the rate of return is the same constant throughout. But then you have what you would call your common shares. Your common shares are attached to different rates of return because on these ones, you don't have a fixed rate. Now, what's the major difference in these two common shares and preference shares? Preference shares do not come with voting rights. They are not accompanied with voting rights in terms of decisions of the company. But your equity, your common stock has voting rights. Now, what's the other difference in these two? You find that preference shares tend to be given first consideration in receiving dividends and first money back guarantee in the event of the company going bankrupt. Are we okay there? Are we okay there? Are we okay on that statement?
Yes, sir.
Okay.
Yes, yes.
All right. So because of this, you find that some people will pick preference shares over common shares because their investment is safeguarded regardless of whether the company makes a loss or they make a profit. Now, why do this tend to lack? What preference shares lack is a point where the company makes abnormal profits. Assuming the company makes, let's say, 20 times profit in a particular year, common shares will be given dividends in proportion to that particular excess profit made. But then preference shares will be given the same amount they receive every time, whether the company has made abnormal profits or not. They will get the same fixed amount throughout, same fixed dividend throughout. Yes. Now, today's focus for us now know how to evaluate our stocks. How to evaluate our stocks. So we'll start by looking at stock valuation methods. So let's get into it. So as an investor, you conduct valuation of stock when making decisions, right? So you're considering whether a stock you're looking at is undervalued or overvalued. So now, when it comes to valuating stocks, we mainly look at two types of methods of valuating stocks. You got your fundamental analysis, and you have your technical analysis. What's the difference? Fundamental analysis deals with the basis of the company and industrial financials, like for instance, the growth, the dividends, and the earnings, and so on and so forth. Whereas a technical analysis will focus more on the historical price movements, the price trends, and price patterns. Are we okay there? So let's get to the different methods of evaluating our stock. So we have what you call your price to earnings methods. So the price to earnings method, what is this? This is a method that estimates the stock's value by using the expected earnings per share, EPS, and the average price earning ratio of the comparable industries in the market. So now, in this one, we're saying, consider a firm, an example here, right? Consider a firm that's receiving $3 per share in earnings next year. If the ratio, the mean ratio, is 15, then what is the valuation of the firm's shares? So I'm going to say valuation per share, value per share, VPS, will be equal to the earning per share multiplied by the price earning ratio of the industry, which in this case is what? Equal to 3 times 15, which will give us $45 as our valuation of the share. Are we okay here? Are we okay? Are we clear here? Madam Esther?
Please come again, sir.
All right. So I was saying that okay, so like I was saying, we're talking about the firm's earning ratio, right? The firm's earning next year is $3 per share. That's your EPS. And then the average mean ratio of the competitors in the industry is at 15. That's the price to earnings ratio. So trying to find the value of the share. So value per share, VPS, will be equal to the EPS here, EPS times the price to earnings ratio, which is PE, P over E, which is now 3 times 15, which is going to give us 45. Are we okay there?
Yes.
Yes, I got it. Thank you.
Okay. Are we all on the same page? Okay. So now, what's the major thing about the price to earnings ratio? So generally, the price to earnings ratio tends to assume that this method assumes that the industry's price to earnings ratio is a good benchmark. It also assumes that you have consistent growth overall in earnings, and then it ignores your dividend policy and your capital structure. So as a result, by virtue of that, the limitations that different analysts may use various EPS forecasting methods and industry definitions or adjusted earnings, which result in different varying valuations. So now let's get to the next segment. Okay, we've actually discussed this already. The great coincidence I just mentioned before. Now let's get to the next method, our dividend discount method. So this method states that the price of the stock should reflect the present value of the stock's future dividends. Now, what does this mean? I've been saying a statement, mentioning the same statement constantly over the past period. So I mentioned that the value of a financial asset lies in the present value of its future cash flows. The value, let's write this down, lies in the present value of its future cash flows. Are you following this? Any questions regarding the statement? Any questions on the statement? Is it all clear to everyone? This statement, is it clear to everyone? Hello?
You can just elaborate more.
Okay, so what this statement just means is that for a value of financial asset so assuming that you've been told, right? They are told that no, in the next 2 years, you'll get 100,000 and then 150,000. This is a short small time diagram I'm showing you here, right? Just a moment. Okay. You have your zero here. You have your year one here. You have year two here, right? Assuming you be given money in both years. In this year, you be given money in year one and year two, right? Now, the money you're receiving next year is not worth the same amount it's going to be worth this year, right? Because money changes over time. Are we clear there? So what do we do in such a case? We bring this back into our current time frame. We discount it back to now. We take a time. It's like we're taking a time travel to the present time now. We're present valuing all this money now. Are we okay there? That statement? Are we okay there?
Yes.
So because of that, you're saying the value of financial asset will lie in the summation of the present value of its future cash flows. So for you to know how much I going to be receiving, how much it's worth now, you have to present value all those amounts to this particular time frame. And then you add everything up now. Are we okay there? Are we okay now?
Yes. Yes.
Are we okay there? Mrs. Hansen, are we okay?
Yes, I'm fine, thank you.
Madam Kafula, are we okay? Okay.
Yes. Sorry, it's better.
All right, lovely. So now, because of that, we use this formula while saying the price of the share is going to be equal to summation of the dividend over 1 plus the rate of return raised to the power time. Raised to the power time. So this model can account, so D is dividend in that particular period, T is the time frame, K is the discount rate. So this model will account for uncertainty because now it's allowing the dividend to be present valued in response to what? The revised expectations. So I'm bringing back the value of the financial asset again. Using K by allowing it to perceive the changes in the required rate of return by investors. So here's an example here. Now, remember I told you about preference shares, right? I spoke about preference shares at some point. So I said preference shares have no time factor alluded to them. So I say in this example says consider a stock that's expected to pay $7 per share per year forever. So whenever you hear a phrase forever, just know this is what you call a preference share, the fixed dividend throughout. Are we okay there? Are we okay?
Yes.
Okay, now it says the present value of the cash flows, dividend payments, in this example, is the present value of perpetuity. So I was saying present value here, PV, type this out, PV will be equal to your dividend divided by your rate of return, which in this case, PV is equal to, your dividend is what? $7 divided by 14%, which is PV is equal to 7 over 0.14, which will give us the present value be equal to $50. Are we okay here? So the value of this preferred stock is what? $50 per share. Are we okay? Are we all okay there?
Yes, we are.
Okay, lovely. Any questions so far? Questions? Questions so far?
No, no questions.
All right, lovely. So this is how we now wrap this segment now. So I say, unfortunately now, the valuation of stocks is not as simple as this, because dividends aren't expected to be forever unless you are told the preferred stocks. Preferred stocks are the ones that have a dividend being there forever. Now, what happens in the case where you have a common stock? Common stock, you're now going to say common stock is equal to what? Present value of common stock okay, present value of common stock is equal to what? The dividend, D1. So we always say D1 because you're now factoring the growth aspect. So instead of D1, we then say D1 is equal to D0 multiplied by 1 plus the growth rate, G, 1 plus the growth rate, G, then divided by the difference between R and G. This is how we get this done here. So I was saying this D0, D1 is a dividend in the following year. Now, assuming you're only given dividend in the current year, given a growth rate, this is why I now say D0 times 1 plus G. And then K is a rate of return, of course. G is a growth rate. Now let's look at the question here. So I thought, if a stock is paying dividend of $7 per share next year, you're now told the rate D1 next year, not this year, but next year, right? That's the D1 initially. So the dividend is going to increase by 4% per year. Required return is that. So automatically, since you're already given next year's dividend, right? Or saying PV is equal to, that's already your D1, 7 over the 14% is 0.14 minus the 0.04, which will give you PV to be equal to 7 over 0.1, which will give us this to be equal to $70 per share. Are we okay here? Are we okay?
Yes.
All right. Any questions?
No questions yet.
Are we also following here? Are we all following? Is anyone behind so far? Is anyone behind so far? I take you on the same
I
page.
think we are okay. Yes,
Okay.
thank you.
All right. Now, what is the limitation of this dividend valuation model? What's the limitation? Limitations are, so you're given this particular part here, right? So I'll just summarize them generally. So limitations here are that firstly, it's sensitive to small changes, small errors in the growth rate and the cost rate of return. And then it's not suitable for companies that don't pay dividends. And lastly, it's difficult to apply to what you call a high growth or a very volatile firm. Yes, these are the limitations. Just a moment. All right, so let's get back to it now. Let's look at this activity here, right? Let's all participate in this activity. So it says we're computing the price of a stock with dividend discount model. Or we just looked at how would the price be affected if the required rate of returns increased? How would the price be affected if you increase? So this is the formula we're looking at, right? So assuming we increase the K here, how would the price be affected now overall? We increase K. Let's give it a try. Are we all following? How would the price be affected? Okay, so generally, right? If you increase K, you discover that K is the denominator, right? You're going to increase the difference there. By increasing the difference there, it's going to signify a lower present value of the price there. So you're going to obtain a lower price at the end of it all if you increase K. If you decrease K, you're going to increase price. So these have what you call an inverse relationship in this case. Are we all clear there? Are we all clear there?
Sorry, sir. I've missed your explanation. Kindly
Okay, yeah,
take me back.
Right, so I was saying that since K is the denominator, right? So if you increase the value of K, you discover that, assuming that the dividend is constant, they form an inverse relationship. So when you increase K, you're reducing the price of the share overall. When you reduce K, you're increasing the price of the share overall. So this just means that they have an inverse opposite relationship. Are we okay?
Yes, sir. So the best way is to keep it lower?
Yes, keep it. No, not generally low. It's just according to the investor's perception of this. Just a moment.
Okay. Wait.
Okay, any questions so far on this one?
No questions so far.
Okay, lovely. Let's look at the next activity question here. Question 2 says that when computing the price of a stock using constant growth model, how the price be affected if the growth rate is reduced? So again, this comes back to this, right? If you reduce the growth rate, you are increasing the difference between the K and the growth rate. So because of that, you discover that your denominator will increase. So which will now signify a decrease in price. So I think when the denominator, so when you reduce the growth rate, you're typically reducing the price. They have what you call a direct proportion. They're directly proportional in this case. So you find that when you decrease the growth rate, you're reducing your price of the stock there. Are we all okay there? Are we okay there?
Yeah.
Yes, sir.
Just a moment. Okay, so let's now look at the next part now. So we're now trying to say adjusting the dividend based on a hybrid kind of focus here. So we know the DDM model allows us to assess any value of the firm, right? The value of any firm itself, even though that the returns are different. So now, from the investor's point of view, the value of a stock, I mentioned this before. From an investor's point of view, the value of a stock is the present value of future dividends to be received over the investment horizon. So the same as saying, present value of an asset is the value of an asset, the present value of the future cash flows. It's the same constant statement here. So for us to forecast the price at which the stock can be sold, as an investor, you need to estimate the firm's EPS, earning per share, after having removed any once-off events or effects in the year planning to sell. So this estimate, right, can be derived by applying an annual growth rate to the prevailing annual earnings per share. Now, here, what I was saying in this case, so an example given here, right? So it says, example 8.4, assume the firm's current earnings of 12 per share, right? So EPS is $12 per share. The future earnings can be forecasted by applying the expected annual growth for firm's existing shares of what? Forecasted earnings is equal to E plus the growth rate raised to the power N, where G is the growth rate in the number of years. Now, we're saying if the investors expect to sell the stock in 3 years and the growth rate is 2% per year, the earnings per share in 3 years will be shown as what? As this. So I'm saying the same formula applies, right? It's going to be equal to the $12 multiplied by 1 plus 2%, which is 0.02. Then everything here will be raised to the power 3, because n is 3 in this case, which now give us 12 times 1.02 raised to the power 3, which will be 12 times 1.02 raised to the power 3 will give us 12 times 1.061208. Then this will be equal to 12.734, which will be $12.73 as our earnings in 3 years. Are we okay here? Are we all comfortable here with this question, this part? Is anyone behind so far? Is anyone all clear? Is anyone having any question here? Are we all on the same page? Okay, lovely. So now, the forecasted earnings per share, right? What we forecasted here can be multiplied by the price to earnings ratio now. So you're now saying industry price to earnings ratio for this one is now 6, right? So now saying 12.73 as the forecasted earnings in 3 years times the PE ratio, which is 6 in this case, which will give us total of what? $76. $76.38 as your stock price in 3 years. So this forecasted stock price can be used along with the expected dividends and the investor's required rate of return to find the value of the stock today. So now you're told this is the stock price in 3 years. In 3 years, right? Strictly in 3 years. Moment. 26.8. So now, if this is the stock price in 3 years, what are we going to do now? Assuming you have a time diagram, right? A time chart here. I'll just write this down just so you can see it. Okay. Let's see if this can work. Lovely. 0, 1, 2, and then we have 3 here. Now, we're told the dividend is what? $4 per share for the next 3 years, right? So receiving $4 from year 1, year 2, year 3, right? And in year 3, the stock price is 76.38. So what do we do in this case? We now find the present value of each of these. Remember, I told you in the beginning, I said that the value of an asset is the present value of its future cash flows. So I told $4, $4, then the stock price 76.38. So we then subject this to the present value factor of 14% discount rate. So I'm saying 4 over 1.14 the power 1 plus 4 over 1.14 the power 2 plus 4 over 1.14 the power 3 plus now the value of the stock price now there, 76.38 the power 3, which will now give us this $60.84 as the value of the stock in this particular point in time now, as of now. Are we okay here? Are we okay here?
I'm a little bit behind
yeah.
on the
Are we behind?
just above that. I think where there's 76.3. Is it 76.3?
Or how we got
Yes,
it?
the earning. Yeah, the earnings in 3 years times earnings per share and whatnot.
Okay, so we found our earnings in 3 years, right? We found this year.
Yeah.
It's 0.73. Now, generally, for you to know the stock price, you multiply your earnings by the price to earnings ratio of the industry, which in this case I told is what? 6. So what I'm doing is multiplying the earnings in 3 years, which we found earlier was 4.73 times 6 to give us our stock price in 3 years. Are we okay there?
Yes, I'm okay then.
Okay, then at that point, we then find the present value of what? The dividends that were given here, $4 per share dividend. So I'll find the present value of all these, because they're in 3 years' time. So now to year 1, year 2, year 3. So I'm bringing them back to what? To year 0. And this stock price is only in year 3. It's only in year 3. So as a result, I'm also going to present value it back to what? Year 0. So I'm subjecting it to 1.1 to the power 3. This stock price here. Then the same as the dividend there. Then this is the power 2, this is the power 1, which will give us now, when you add everything up, you're going to get $60.84. Are we okay? Are we now okay?
Yes, we are. Although I have a question there,
Yes, please go ahead.
why isn't the the $76.38 on the first? Is it $4 over
For the first year,
1.143?
on the first year, right?
Yes. Yeah.
Yeah, I understand the
For the
confusion there.
yes,
So,
for the
all right, now we're told, right? We're trying to apply the growth rate, annual growth rate in 3 years, right? So the reason why is that the forecasted earnings that we got are for 3 years. The forecasted earnings that we got, the 12.73, is for the third year. What we're earning in 3 years in total. So now we can use the forecasted earnings by the PE ratio to get what the stock price will be only in year 3. We don't know how much it's worth in year 2. We don't know how much it's worth in year 1. We only know how much it's worth in year 3. That's it. So now, for us to find the one that's in year 1, we have to present value up to year 1. In year 2 up to year 2. Are we okay there?
yes.
Or now okay? Okay, lovely.
Yes, we are.
All right, that's wonderful. Now, what do you think are the limitations of the adjusted dividend discount model? So the limitations of this model is that you get to have errors in forecasting the sale price or selecting the PE ratio, because this can distort the actual value of the firm, of the asset or the investment here in this case. Are there any questions at this point? Any questions at this point? Any questions?
No questions.
No questions?
No
Okay.
questions.
All right. So we're going to wrap up here for now, because our next session now look at the free cash flow method and your CAPM method, because now we're going to now dive into the required rate of return on stocks using the risk-free approach now, the CAPM approach, and also going to ascertain the return aspect now in our evening session. Well, now we're going to wrap up here. Are there any questions at this point in time? Are there any questions? Are there any questions so far?
No.
Okay. All right. Madam Kafula, questions? Are we all clear so far? Mrs. Hansen, Madam M, questions? Are we on the same page? All right. I take it we're on the same page. For now, I'm going to wrap up here. Thank you for your time. I'll see you at 6 p.m. Have a good day.
Thank you.
All right.
Thank you.